first off, I don't know, the Romans, the most successful ever. I mean, the Brits, come on, like a third
Yeah.
of the world. Like, come on, man. Uh,
I'll give you that one.
and then, I mean, then some people would probably argue that the modern American empire, the military industrial one is maybe more successful monetarily, at least, anyway. Or Genghis Khan militarily could maybe be. Anyway,
I
that's getting in a different
I
direction.
like the US example too, because the US example, they were kind of founded on free market and capitalist kind of ideology in the 1770s when it was founded. And America's been one of the most successful empires because it tried to stay out of the money supply and not centrally plan. They embraced capitalism, and that attracted capital from all around the world. So,
Hmm.
um,
Yeah. So one of the things I like that you said there, I wanted to ask you about was, do you know, like, in more detail about this Roman debasing of the currency? I've never heard of that before. Like, could you talk a little bit about that and tell me a little bit what that's about?
Yeah, so I did a podcast on this one with Drew McMartin. He's also a fellow Bitcoiner, and we actually looked at the charts. It's on YouTube, so we screen shared and had a look at the charts of the rate at how quickly the Romans began to debase their silver denarius coin. Essentially, their empire just grew so large that by the end of it, they were struggling to pay their expanding military. And so to compensate for that and to try and pay for their military, the Romans actually started debasing their coin for the first time in 600 or 700 years from memory. So yeah, and as with any currency debasement, it always starts off very slow and gradually at first. But then the more the debasement goes and the higher the inflation gets, the more rapidly you have to debase that currency to keep up with the expanding amount of debt. And that's obviously the issue with an inflationary monetary system, that it needs ever expanding amounts of debt and ever expanding monetary creation to keep itself going. It is essentially a Ponzi scheme. And that's why you've got 750 examples of failed fiat currencies throughout history. So yeah, if the people are interested, go and check that podcast out I did with Drew and Martin, because we talked about it for a good 20 or 30 minutes, just that case of the Roman Empire collapsing, and we go through the charts of the silver denarius, and there you go.
Is this one of them?
This looks similar. Emperors with no clothes.
This made me laugh just because it had Obama with the Caesars thing on it.
Yeah.
But
Yeah.
I guess they're tracking like how the currency became how the denarius became debased versus silver against the dollar and gold. I guess that's what they're tracking and showing, like,
Yeah, so
similar, isn't it?
it is. So you can see how, so the blue line's the silver denarius. You can see it starts at nearly 100 at 55 AD, and see how it kind of gradually works its way down over 100 years or so,
Yeah,
very slowly. And then at the end, it really drops like a rock. So
yeah,
that's kind of, so what we did, if you invert that chart and flip it upside down, it actually looks a lot like all of the hyperinflationary events throughout human history. The debasement's very slow and gradual at first, and most people don't notice the debasement when the inflation rate's at 3, 4, 5, 6, 7%. But once inflation gets above that 10 to 15% per year, that's when the everyday person starts to notice that, hang on a minute, this debasement's going at a really rapid rate. I need to get rid of this currency as quickly as possible. And that's where you get the really rapid debasement at the end of a fiat currency, because nobody wants to hold it.
So
So
do you
it's a
think,
great chart.
is that what we're seeing now? Is that where we're at? I mean, I
Yeah.
I, I saw this unbelievable picture today, which was brilliant, and it was like, inflation doesn't exist. No way, it's transitory. No way, it's corporate greed. No way, it's something else, and then no way, it's Russia. Like, I
Yeah.
was just like, wow. Like,
Yeah.
how far will they go to explain this without saying, it's like, maybe we shouldn't have printed like all that money? Maybe,
Yes.
just maybe.
Exactly, dude. Exactly. You've absolutely nailed it. It's absolutely absurd. The excuses. that they've got to blame the inflation on, whether it's supply chains or corporate greed. That's a massive one. But they've never, ever, ever once blamed it on the expanding monetary supply. And that's essentially what's causing the inflation. If you increase the size of the monetary supply and you don't have any extra goods and services, that's naturally going to cause goods and services to rise in price because you've got more money chasing the same amount of goods and services. And that is, I think we really are kind of at the tipping point. We're at a stage where interest rates are at zero, and we have the largest debt bomb in human history. I think there's a really good really good report done by someone called Hirschman Capital. I suppose they're a hedge fund, but they looked at sovereign defaults of like sovereign countries, and they found that since the year of 1800, 51 out of 52 countries that accumulated a debt to GDP ratio of greater than 130% defaulted on that debt. So you get above 130% debt to GDP, there's a 98.5% chance that you're going to default on that debt. And generally, the way that nations preferred to default was through currency inflation, currency devaluation, and hyperinflation, because it's much more politically palatable to do that when you're in a debt burden. The other option is obviously austerity. And if you get to a stage where you have 400% global debt to GDP ratio, and you just say, look, we're going to stop printing money, we're going to let assets and stock market and the housing market correct to its normal value, you'd probably see an 80 to 90% correction in risk assets, and you'd have a global depression like you saw in the 1930s. So the more politically palatable decision to take when faced with that 130% debt to GDP Rubicon is to print your way out of it. And you simply, throughout history, Hirschman Capital showed that central banks and governments preferred to simply devalue the money and pay back their massive debts with the devalued dollars. And that's obviously where we are today around the world. The US national debt is, I think it was 138% last year. They've brought it down to about 123%, but they've still got a long, long way to go. And
yeah,
you've got other countries like China that have roughly 300% debt to GDP.
I was just pulling that up there for people. I'm not sure if I think you should be able to see that there. Is the US debt to GDP ratio. So 2020, 2021, and 2022. Now it's claiming that this is not that this is going down at the minute, but we're still hovering around. And then I guess these are predicted ones, but it's hovering around that 130% mark, as you were pointing out, which is a little scary, isn't it?
And there's a playbook for how to deal with this debt for central banks. Like you kind of asked, where are we? I would say we're at the end of an 80-year long-term debt cycle. So Ray Dalio has written a book called Big Debt Crises. I pronounced that word a little bit wrong, but he looked at how governments have defaulted throughout human history. And generally, he has this really good video on YouTube. I think it's called How the Economic Machine Works. I recommend everybody should go and definitely watch that video. I've watched it 4 or 5 times, and I still learn something new every single time I watch it. But he essentially just shows how an economy goes through these long-term debt cycles. We're all familiar with short-term debt cycles. They're called recessions, and we have one of those every 7 to 10 years. So everyone, obviously the coronavirus recession in 2020, and then obviously 10 years or so before then, we had the 2008 global financial crisis. About 8 years before then, we had the 2000 stock market, tech bubble crash, and then obviously the 1987 stock market crash. So you can see they're like kind of the little pivots or the little dips along the way. They come every 7 to 10 years. But then every 80 years, you get to a situation where you have a very, very, very large deleveraging event. And that's where all of the excess investment and excess debt gets wiped out. So they come along every 80 years. And I think we're at the very peak or the very top of an 80-year long-term debt cycle. And we're about to witness a pretty large deleveraging event. The only question is, what way are we going to see the deleveraging? Is it going to be through a 90 to 95% deflationary crash like we saw in the 1930s, or is it going to be more of a hyperinflationary kind of deleveraging event where the currency is sacrificed to nominally decrease the debt levels? So there's I think there's a really good quote. There's decades where nothing happens, and then there's days where decades happen. Something like
I think
that.
it's weeks where decades happen.
Yeah, that's the one.
As far
That's
as
the one.
as far as I remember. Thanks for making it all the way to the end of the video. Don't forget to like, share, subscribe, and leave a comment for us in the comments below. Let me know what you thought and if you'd like to see more of this from the show. Thank you, and we'll see you again next time.